Last week we had questions for a lender based on our first-time buyer videos, and here we're going to run through a couple of those questions with Kammer from CrossCountry Mortgage. Does PMI ever go away? What are the options for financing PMI or paying it all up front?
So on a conventional mortgage, there are a few different ways to structure your PMI. You can either opt to pay it monthly. You can opt to do a financed lump sum premium, which is a one-time buyout, and you finance that amount back into your loan. Or you can opt to pay it as a lump sum at settlement. You can also opt to take a higher interest rate in exchange for what's called lender-paid PMI. So there's definitely different ways that you can structure it, and that's something that we would go over when you apply and see what works best with your situation and your budget. On an FHA loan, you do pay PMI for the entirety of the loan if you put less than 10% down.
Okay, as a first-time buyer, do I have to put 20% down?
You absolutely do not have to put 20% down as a first-time buyer. I would say that it's extremely rare that a first-time buyer puts 20% down. On average, I'm seeing most first-time buyers putting down anywhere between 3 and 5%.
How much can I expect to pay in closing costs in addition to my down payment?
So closing costs are one of those things that definitely varies by the state and the county that you purchase in. If we're talking about Philadelphia County, closing costs on average run about 5 to 6% of your purchase price. So that's a big shock for people because it might end up being more than your actual down payment in terms of closing costs. In terms of what makes up your closing cost, you have title insurance fees, transfer tax, recording fees, lender cost, third-party costs such as your appraisal, your credit report, and then you have your escrows and prepaids, which are your real estate taxes, your homeowner's insurance, and prepaid interest. And then you also have to account for, the cost of home inspections that you might be getting done. So they can add up quickly. It definitely is more of a case-by-case basis since it does depend on the area that you're purchasing in and how much real estate taxes are going to be. But there's, options to offset closing costs as well if you're asking for seller's assist, if you're doing some type of grant program, or if you're taking a higher interest rate in exchange for a lender credit. So there's ways to make the numbers work depending on your budget.
A first-time buyer, they have a lot of student loan debt. Will that hurt getting a mortgage? Will it hurt them getting a good rate? Should they wait to buy a house before they pay off their student loans?
So the student loan debt in itself doesn't necessarily affect your ability to get a mortgage at all. I've seen people with hundreds of thousands in student loan debt have no trouble getting a mortgage. It depends what type of loan you qualify for, what type of loan you're getting, and what type of repayment you're on with your student loans. So on a conventional loan, you can use income-based repayment to qualify. The real fear of student loans hurting you is if they affect your debt to income ratio. So if you are currently in, deferment or forbearance on your student loans, if you're not making payments at all, then the lender has to use, for the most part, 1% of the outstanding balance of your student loans. And that's where it can get a little bit tricky. So it does depend on your, individual situation, but it should not hold you back from getting a mortgage.
And last question, what is the main differences between a conventional loan and an FHA loan?
So a conventional loan is backed by Fannie Mae, Freddie Mac, and a FHA loan is a government-backed loan. So they're definitely two completely different types of programs for two different types of, buyers or borrowers. Conventional is designed for higher credit scores. There's many more ways to structure PMI on a conventional loan, whereas with FHA, it's a set rate for your monthly PMI, and you also have a set rate for an upfront PMI premium that gets financed back into your loan. So conventional loan, I would say, would definitely be a better product. It would give you more options. Overall, typically a lower monthly payment, but it really depends, what you qualify for. Sometimes FHA is the right type of loan depending on your credit score, your debt to income ratio, etc. FHA does allow for lower credit scores. We lend as low as a 580 credit score on FHA, and it does allow for higher debt to income ratios.
Well, thank you so much for answering all of our questions.
Of course.